Hello, good morning, everyone. Welcome to all of you for today's session. Students, just let me know whether you people can hear me well. Can you hear me well?
Yes, sir.
All right, so just give me 2 minutes only. I'm going to start the lecture just in 2 minutes. Okay, just 2 minutes, please. All right, so I have shared with you the folder of the notes already. So where I have uploaded this document, I think yesterday or day before yesterday. These are the 10 benchmark scenario questions on audit risk. And out of that, we have solved two questions in the last class. We have already done two questions. And those two questions were green company. We solved the question green company already and Megbuy. So today we will be proceeding towards more exam question scenarios. Remember, in double A, the answer of getting passed that lies in your exam answer drafting. And I have been telling this to you people again and again. Unfortunately, students are not taking it serious at all. And they think they can pass the paper the way they want. Okay, and they will be at a very high risk if they do not practice questions the way I am asking, if they do not solve the assignments the way I am asking, it will become problematic for them. I'm warning you people in advance, because it has been observed over previous around more than 15 years of teaching audit and assurance FH. Now, so the today's question which we need to do is, that is, let me open in front of you people the question from the exam kit. That is Harlem company. The question is Harlem company. I'm opening the exam kit in front of you. So Harlem company from the exam kit is the question number 210. So 210 question we need to solve. Here we are. In this question requirement, Harlem company, they ask us use the table below. Calculate four ratios for both years to assist you in planning the audit of Harlem company. So basically, these are analytic part of analytical procedures that we calculate ratios, trends this year and the past year. And we analyze and we say that what may be misstated in financial statements. So four ratios are here. For both years, they need to be calculated and discussed. Not discussed in the second part, not here. Here just we need to calculate for 4 marks. GP margin, inventory holding period, and gearing, and interest cover. So data is given to you people over here in front of you. So gross profit margin, we can calculate, GP divided by revenue. Simple is that. And which I have calculated in the answer over here, you see. So gross profit divided by sales into 100. Simple is that. Then inventory days. So total inventory divided by cost of sales into 365 days of year. So same for this year as well. So now it is calculated here. Days. Then is gearing. So gearing is calculated just a minute. They have told us in any way to calculate gearing. So debt to total capital. Debt divided by debt plus equity. Same. We will calculate it. Just see here. Gearing here. Then interest cover ratio. For interest cover, we know that is calculated profit before interest and tax divided by interest expense for the year. So interest expense is given here. You see. So what is profit before interest and tax? We need to calculate for both years. Profit before interest, income tax is given. Gross profit is given. And you see here, this can help us to calculate PBIT. How? 450 is profit before income tax. This has been reached by deducting it. So PBIT for this year will be 290 plus 450. Then 290 is deducted and profit before income tax is calculated. And here it will be 850 plus 250. So interest expense. So this is how it is given. So PBIT is calculated and then interest cover. And now ratio, basically, this calculation has 4 marks over here. But the point is, we are auditor here. We are auditor here, and we need to analytically review these ratios. And you see, this margin is falling. For the second part, I'm telling you, for the audit risk part, receive inventory days are increasing. Inventory is staying for long in the stock. So what does it mean? It is clear indication that inventory may be overstated. It may not have been, it may, why? If you write only this, you won't get marks. The inventory may be overstated. How? When you are explaining audit risk. So you have to explain it that it is staying for longer in the stock, in the stores. So two possible reasons that inventory may not have same value. Number one, it may not be in demand as it was before. So its price may not be the same in the market price. So NRV may be lower than cost. Second, when inventory is staying for long in the record, in the store, sorry, so it means the risk of obsolescence, obsolescence of inventory is increased. So it may need to be written down to its resale scrap value or saleable value. The risk is that management may not have assessed its NRV, which may be lower than cost, and may not have written it down. And hence inventory may be, in this way explanation is needed. Now gearing is increasing, okay, and interest cover is falling. These both indicate the company is getting high risk. High risk company. How high risk? That at any point of time, they may not be able to pay their interest. Now we need to find some relevant points from the scenario for the second part. Some points may be present in the scenario. Some covenants are attached with the loan. Covenant conditions of gearing, conditions of interest cover, covenants. Covenants are conditions. So if they are breached, that may become problem for the company. Loan may be recalled, going concern issue may arise. That may need to be disclosed. Now come back to the scenario. So for the second part, although for the second part, I have explained number of points over here while solving A part. But for the B part, the question using the information provided and the ratios calculated. Describe 8 audit risks and explain auditor's response to each risk in planning the audit of Harlem company. Now, the point is 8 audit risks. Come here. It is 1st July 20x5. You are an audit supervisor of Brooklyn and Company, and you are planning the audit of Harlem Company. for the year ending 30th September 2025. The company has been a client of your firm for several years and manufacture car tires, selling its product to wholesalers and retailers. The audit manager attended a planning meeting with the finance director and has provided you with the following notes of meeting and financial statement extracts. Planning meeting notes. Harlem company sells approximately 40% of its tire to wholesale customers. And now, these customers purchase goods on sale on return basis. Now, this is something different over here. It is called consignment stock arrangement. Okay, this is called. Now, next. The next point is, under the terms of this agreement, the wholesale customers have 60 days during which any returns can be made without penalty. The finance director has historically assumed a return rate of 10%. However, now feels this is excessive and intends to change to 5%. Now, having professional skepticism in our mind that the company is selling, sorry, not consignment, this is not consignment stock arrangement, but it is basically, yes, that the customers, they can return within 60 days. So what is the issue? How it is a risk? What is the risk? The risk is that the company should ability at appropriate amount, but they're going to reduce it from 10% last year to 5% this year. %10 last year to 5% this year. So without any valid reason stated, the risk is that the reduction may not represent the actual return rate, which may be higher than this, and sales may be overstated. Risk and impact IRI. If you remember my last lecture, which I explained to you people that how audit risk needs to be explained. Identify risk from scenario. How risk arises, what can go wrong in financial statements. This how need to be explained. Yes. Explaining issue, what is wrong, what is risky. What does this create a risk? Why does this create a risk? Impact on financial statement. So these three. Now, So come back to the answer of this question. Yes. Harlem sells goods to its wholesalers on issue from scenario. Now, how it is a risk? You need to tell that they should record a refund liability, appropriate amount, but they're going to reduce from 10% to 5%. So reduction may not represent the actual return rate. It may be higher than this. So hence sales may be overstated. So you see here, this is issue which is causing the risk, although this is issue as well. Now, how risk is arising? From this to this, risk explained, and this is impact on financial statements. Now, they're going to reduce. This is the risk on wrong basis. So discuss the reason for reduction of return rate to 5% with finance director and assess the validity. So this is audit for substantive test on this issue to verify why you have reduced and assess the reason. Another way, if you write only this, that's enough. The return rate for last 60 days sale should be reviewed to assess the reduction of rate to 5% is appropriate. Another way, both are correct. Responding to this risk of misstatement. My screen is frozen. I'm sorry. You are silent, not telling me why it is frozen. And I'm explaining the answer. Since how long it is frozen? My screen. People are silent. They're not talking. Why? If you can't see what I'm writing, please do tell me. I just noticed. So please, if you keep sitting there, means not speaking, how issues will be resolved? Now, I'm speaking since last 20 minutes and you are just seeing only one screen and not speaking. Mr. Hamzah, why screen is not? You see my analysis, what I'm writing, and you have not seen anything. I'm surprised. Now, what should I do? Tell me, please, have you seen this calculation the way I did? Okay. Right. So it got stuck when I was explaining audit risk, right? At that time, please, you can open your mic and talk to me. Okay, right. All right.
Actually, we saw what you've been explaining and on the audit risk, that is the revenue recognition. But on the second page of the audit risk, we have not been saying it. That is the estimated return risk, that part.
Okay, great. All right. Next point. The company purchased a patent on 30th September 20x4 for 800,000, which was capitalized. You see, repetition. I told you my repeated audit risks I have shared with you. I don't know whether you have prepared that or not. Last lecture. So 800,000 which were capitalized in the prior year as an intangible assets. This patent gives Harlem company the exclusive right to manufacture specialized wet weather tires for 4 years. Now, so 4 years they purchased intangible assets. So what is the point? Issue. The company has purchased intangible assets. 800,000. Having life of 4 years. Now, as per IF 38, purchased intangible asset, patent rights should be amortized over its useful life. So here it should be amortized over 4 years. And we can see intangible asset, it is recorded at same value. Now you should be alert. It should have been amortized over 4 year life, but it is still recorded at same value of last year, 800,000. So accounting treatment, it means it has not been amortized, which is against IFRS. Risk is being explained. What is impact on finance? What are understated or overstated? Intangible assets are overstated. Expenses are understated. And profits are overstated. So how to explain it? Come here. The company purchased a patent worth issue. Now risk explained. So what is how to explain? As per IFRS, it should be amortized over its useful life of 4 years, but it is still recorded at same value in five statements. So treatment is incorrect. What is impact? This is R and impact. Now, incorrect treatment. When treatment is incorrect, now we will discuss with management. Why they have not recorded, discuss the reason with management. For not recording amortization charge on patent with management and request them to record an adjustment for the same. Then next, come here. As a part of review, surplus items of plant and machinery were sold, resulting in a loss of disposal of these. Loss on disposal or profit on disposal. They indicate assets are not being depreciated with proper depreciation policy and rate. So depreciation charge is incorrect on the asset. That's why at the end there are loss or profit. So hence, what is impact? It is clear indication. This is incorrect. So hence, assets or profits may be misstated. And when there is loss on disposal, it means they are not being charged with accurately. They are charging less depreciation is being charged than it should have been charged. So depreciation charge is understated, and profits and assets may overstated. So yes, come here. Issue. The loss indicates assets may not be depreciated at a proper rate, and hence policy of company is not correct. Depreciation policy, risk, impact. So discuss the depreciation policy for the plant and machinery for the finance sector. Discuss with them. We have to respond to this risk. Discuss with them that losses are arising on disposal. Why it is happening? Assess the reasonableness of the policy. Now, the next point is student, there is only one way to master this art. That is assignment written work. If you are not doing that, I'm saying again and again, if you are not solving the question scenario by yourself, you are not preparing for exam at all. I don't know, I can't emphasize it enough. I don't know how to make you realize it. The financial controller of Harlem was dismissed after it was alleged that the financial controller has carried out a number of fraudulent transactions against the company. He has threatened to sue the company for unfair dismissal and disputes the allegation. Company has only started to investigate the extent of fraud now. So two things are there, but let us discuss one only. He is threatened to sue for unfair dismissal. So as per IS 37, if the payment is probable to financial controller for unfair dismissal, payment is probable, then provision for the same should be recorded. If payment is possible, then contingent liability should be disclosed. The risk is that provision may not be recorded or disclosures may not be given. So liabilities may be understated or incomplete disclosures. Simple is that. So how to explain it? Issue, risk explained. Unfair dismissal, if it is probable, provision should be recorded. If it is possible, disclosure should be given. Impact, the risk is that the required provision may not be given by the company, leading to understatement of provisions or incomplete disclosures. In any case. Next. How to respond to this risk? Now we need to, being auditor has to apply substantive tests to verify probability of payment. So what is the source? Board minutes, discussion with management lawyer of company. The issue of unfair dismissal to assess likelihood of any payment to be made. Assessing this, and I'm telling you, I don't know how many times I have practice. Spend time. You can't master it by listening me only. You have to jump into the water. Okay, now a problem occurred in June 20x5 during production of significant batch of tire, which now you see repetition. The affected the quality of tires. They are investigating whether the inventory, damaged inventory. With this, we can mention the increase in number of inventory days, which increased from 34 days to 41 days. Inventory, we calculate it. So two issues. So inventory may need to be written down to NRV if its cost is higher and NRV is lower due to infected quality, or the inventory is staying for long. It may not be saleable at same price. The risk is that the required write down may not be done by the company, and inventory may be overstated. Now, just see here. Quality of tire affected, inventory days, issue. What is the risk? Inventory may need to be written down to NRV if it is below than cost. It may not have same selling price as before. The risk is that required write down may not have been done by the company and impact. Now, addressing it with on NRV. Response, describe detailed substantive direction of audit work. I told you, response can be direction of work. It can be substantive test. It can be test of control or both. On cost and NRV of the company to verify it is recorded at. So direction with purpose. Response should be direction with purpose. What should be done and why? Procedure should be performed and why? Even substantive tests and test of control, they are procedures with purpose. Purpose should also be explained. Procedure, what to be done and why to be done. Purpose is very much important. Next. Harlem company's finance director has informed you that in March 20x5, a significant customer was granted a payment break of 6 months as it has been experiencing financial difficulties. Harlem company can maintain an allowance for receivables, and it is anticipated that it will remain at the same level at the previous year. So the story is telling itself what is wrong here. When a significant customer is experiencing problem, payment, and allowance for receivable has not increased. It is same. So the risk is that that allowance may not cover this specific receivable, which is now has become doubtful. Which may not be received. Now, so students, what is misstatement? The misstatement is that impact provision for doubtful debts may not cover these doubtful debts and may be understated. And what is overstated? Receivables may be overstated. Now, the next is, let us do analysis of the answer. Issue. And you see here, we have added the receivable days increase as well. The company is maintaining allowance for same levels. Due to increased collection period, an allowance for receivable required may not be sufficient to cover that, and hence receivable may be impact risk explained. What is the direction of work on the allowance for receivables? Discuss with the finance, ask them why allowance is same because of these two factors, and assess the validity of the response. Now, the next point is the report to management issued by brokerage companies last audit highlighted significant deficiencies related to purchase cycle. Now, this is unusual. So if these controls were not improved in the purchases, it means purchases may not be recorded at correct amount. Cost of sales and payables may be misstated. Very easy. So come here. Issue. If these deficiencies are not addressed, rectified by company, control will be weak and risk and impact. So discuss with management. Now responding to this risk, whether deficiencies are improved, and perform detailed test of control on purchase system to verify they are working properly. Test of control, direction of audit work. This is the direction. You see. Now, this is the purpose. Now, the next point is the finance director has informed you that the company intend to restructure its debt. After it will be looking to consolidate loan to reduce overall cost of borrowing. As a result of planned restructuring of debt, Harlem has not paid dividend this year. Instead, chosen to bonus issue. So bonus issue. So bonus, how it is issued? We know that reserve is utilized and it is converted into equity. So the point is, the risk is that the company may not have recorded the bonus correctly. Equity may be misstated. Now, so audit procedure on the same will be performed. Audit procedures on the same will be performed. Next, come here. So Harlem has issued bonus issue shares, and reserve should be decreased accordingly. Share capital should be increased. Issue. Risk impact. Review accounting treatment of bonus issue in the accounts and verify equity has been increased and corresponding reserve decreased or not. Now, the first part, restructuring of debt. Their gearing ratio is already increasing and interest cover falling. So high risk, they might be manipulating financial statement, showing understating liabilities. Overall risk. So auditor has to exercise professional skepticism while auditing the financial statement, especially those involving judgments. So student, this question is complete. Now, the next question is a similar question. This is the latest past paper question answer available. I will share its video recording with you people. Pimento. So Pimento company and what else? Recordings I will be sharing with you people. That is Lapis, Knight Electronics, and Pimento. Yes. Recording will be shared. It is also done. Harlem. Now, let us proceed to Peony company in the exam kit. Okay, it is next to Harlem. Yes. 8 audit risks and explain, alter the response. 16 marks. Come here. I will give you 5 minutes. Open it, read it well, and then I will talk about it. Be quick. All right, I hope you have gone through it. So 8 audit risks and audit responses. So it is 1st July 2025. You are also supervisor of Daffodils and Company and planning the audit of Peony Company for the year ending 30th September 2025. The company is a food retailer with a large network of stores across the country. And 4 warehouses. The company has been a client of your firm for several years, and the forecast profit before income tax is 28.9 million. The audit manager has attended a planning meeting with the finance sector and has provided you with the following notes of the meeting. The company has an internal audit department which undertakes control testing across the network of stores. And then each store is visited at least once every 18 months. The audit manager has discussed with the finance director that external audit team may rely on the, now this is a bit tricky. That they will rely on the work of whom? They will rely on the work of internal audit. External audit is going to rely on the work of internal audit. This is one point. I will leave it. I will not discuss it. Try to find more points. Okay? A bit tricky. During the meeting, the finance sector provided some forecasts. Revenue for the year is expected to increase by 3%. Gross profit margin by this. Operating profit margin is going to decrease from 21% to 18%. Now, what does it mean? This inconsistent trend. GP margin is increasing, sales are increasing, but net profit margin is decreasing. So at least these margins should have same trend. The risk is that some costs may have been omitted. That's why GP margin is increasing. Or some cost which should have been charged direct cost may have been charged with indirect cost. Misclassification of costs may be there. This is the risk. So what is the impact? So the cost may be misstated. Then they're misclassified. So hence, so what is the response? Obtain breakup of costs. Cost of sale and other costs from the last year and this year. Compare. If there is unusual change, investigate. So come to the answer to this question. Peony Company. Here. Gross profit margin. You see, issue. What is risk? What is impact? Inconsistent trend. Costs may be misclassified as indirect costs. So what is response? Breakup of obtain these costs. Compare. Unusual change, investigate. So risk addressed with audit work. Second point. Peony obtain value inventory. The value inventory line the industry practice, which use selling price less average margin that a fund director considered to be close approximation to cost. Third point. valuation of inventory, selling price less profit margin. And this it is close to cost. We know that IS2 says that inventory should be recorded at lower of cost and RV. The risk is that this method may not be recognizing inventory at lower of cost and RV. And inventory may be misstated. Both possibilities. Both possibilities are here. Now, the company does not, so third point. So what is the substantive test should be performed? The same issue. What is risk and what is impact? So response should address risk, perform substantive test retail inventory. Verify it is recorded lower of cost and RV. And whether selling price less average profit margin is close to cost or not. Next. Sorry. Yes. The company does not undertake a full year inventory count and instead undertakes monthly perpetual inventory counts, each of which covers 1/12 of all lines in store and the warehouse. As part of entire model, which was completed in May, and our junior attended a professional inventory count at one of the warehouse and noted that there were a large number of exceptions where inventory record showed a higher quantity than physical present. When discussing these exceptions with the financial controller, the junior was informed it was a recurring issue. So record is showing higher quantity than physically present, and it is a recurring issue as per financial controller. What is the risk? So it means inventory present in store, it is not reflecting inventory recorded in record. And 1/12 inventory is counted at year end only. So at year end, only 1/12, because every month 1/12 is counted. So the one which was counted in the first month, it will be counted in the next year. So it means that the inventory may be misstated in record and it may not reflect. So full year inventory count should be performed at year end. Full year end, full inventory count should be performed at year end. This should be discussed with the management. Now, so come here. During attendance, the issue. Exceptions were noted, higher quantity than physically present. And financial controller, it was a recurring issue. What is the risk? But inventory present in store does not reflect Next, what is the response? And this is impact, of course. Discuss the inventory exception issue with the management and request them to perform a full year inventory count, full year end inventory count. Now, the next point is So it was the fourth. During the year, internal audit performed a review of non-current assets physically present in around 1/3 of company stores. A number of assets which have not been fully depreciated identified as obsolete. So depreciation policy is not correct. They are obsolete. So they are being charged less depreciation than required. Around 1/3, huge amount. So assets and profits are overstated. So what order should do? Two things now. First of all, depreciation policy should be reviewed. Discuss with the management. Request them to revise it to reflect correct useful life of asset. Second, detailed substantive test on non-current asset to identify obsolete asset and to write them off. Yes. Issue, risk, and impact. You can see what I told. Same is written here. And this is a response addressing the risk. Now, the company launched a significant TV advertising campaign in my 20x5 in order to increase revenue. I have not included more answers of this question. So because I want you to write answers here and show me live, I will mark your answers. To increase revenue, the director have indicated that at year end, current asset of 0.7 million will be recognized for advertising. Believe that advertising will boost future sales. The last advertisement is shown, will be shown in September 20x5. Now, what is the problem? The problem is that they are going to recapitalize 0.7 million advertising cost as per IS 38. As per FRS, advertising cost cannot be capitalized. It should be expensed out. So recognizing it as asset will be wrong. So intangible asset or current asset will be overstated and profits as well overstated. Expense is understated. Now, I want you to discuss, open your laptops, some Word document, write its answer, how you will explain it in exam, this point. Be quick. And copy and paste in the chat box. I will review your answers. Be quick. Be quick. Be quick. I want you to type this in a Word document, how you will write this risk in exam, and copy and paste in the chat box over here. Then I'll review your answers. Here, I will tell you what you are missing. Okay? Be quick, please. How you will explain this point in exam? Be quick. Others as well. This is the answer received from one student. You see, Peony company has incurred significant television advertisement expense, and yes, intend to agonize. This is the issue. Very good. This is the issue. Incorrectly capitalized. Risk is that? No, here is not risk. Here is clear incorrect treatment. Because yes, it should be expensed. No, please. Straight away, IF 38 says that it should be expensed and cannot be recognized. So what they are doing, that is incorrect. Now, how to write this answer? I will explain. This is why I wanted to. Impact is okay. Risk explanation is incorrect. Where there is clear incorrect treatment, we cannot cite either risk. Clear incorrect. Okay. No, yes, this is correct. Now I will explain what is wrong and what is correct over here. Okay. So more answers are being received from the students. Under IAS 38, now where is the issue? Issue should come first. This is not prepayment. Please, advertising cost. Where is you have discussed that? That's correct. Call it this capitalization is incorrect. Okay. Another answer is here. You know, in this way, the learning is enhanced. When I ask you to write answer here. Another answer is coming by one other student. Yes. So as per, where is the issue? Sorry, where is the issue? Forgot. Where is the issue? Okay, right? So still they cannot capitalize it. Still they cannot capitalize it. Now, why I involved you people in drafting this answer? Because I know I keep explaining and you may not learn. I will type answer over here in front of you people, myself. So, Peony company has capitalized incurred advertising cost during the year as current asset as management. What management is saying? Where is the question? Let me see what management is saying. That as management says, it will boost future sales. So what they said? This is the issue. How it is a risk now? As per IFRS, which is IS 38. If you don't remember, writing IFRS will be sufficient. Advertising cost incurred for which services have been received should be expensed in profit and loss for the year. So recording it as current asset. Now you see here, learn it, learn the art of drafting answer. Recording it as current asset is against IFRS and incorrect. And is incorrect. Hence, current assets and profits are overstated and expenses understated. Now you can see yourself, majority of you who wrote answer, they missed it issue. They simply jumped over it and they didn't discuss it properly. This is the point to be noted, to be learned. Now, what is the response? Now, incorrect treatment already done by management. So the response will be a bit different over here. Request, discuss with management the incorrect treatment of advertising cost and request them to remove current asset and record it as expense in profit and loss statement for the year. Any confusion? Now, this is how I want you to do this. Now, another point I will explain to you. Then I want you to write it. Instead of I am analyzing only. Analysis we have done. Now, let's see here. Yes. Peony company is planning to expand. I'm sorry, tech ache. This is also called tech ache. Pain due to caused by the technology. I'm sorry. It is happening second time. I'm sorry for the inconvenience. Yes, here we are. Peony company is planning to expand the company. My screen is visible to you people? Yes, now I think this is visible now. Okay. By opening so Peony company is planning to expand the company by opening 3 new stores during the November 2025. In order to finance this, the company obtained 3 million bank loan, repayable in arrear over 5 years. Now, how to discuss it? Loan to be repayable over installments. Issue. What is the risk? It should be recorded as current liability and separated into current and non-current liabilities. And every installment should be classified into principal, repayment, and interest. The risk is that this recording may be incorrect and liabilities may be misstated. So please be quick. Write it down. Risk and response. Be quick. Share its answer. Be quick. Others as well, please. Yes, more answers, please. Now you see here what I told you, how to solve the answer. Assess your own answer. Everyone who has written, issue is there, risk properly explained there, impact on financial statements there, risk can be evaluated, audit risk. Where is the issue in this answer? What does mean? What is the meaning? Current and you have to explain first. The loan should be classified into current liability and non-current liabilities. The risk is that they may not have done this class. First explain. Misstated liability, that's correct. Amortization schedule, loan amortization. Ensure, not verify. Quarterly basis. Okay. Very good. Response is okay, but risk is not properly explained. This first one. Company obtained 3 million loan, issue is here. Okay. What is meant by risk? Not explained. No mark for it. Not, and please don't use the word ensure. Auditor has to verify. Please, not this way. Another answer I received, that is handwritten answer, although I don't check such answer because they are not representing exam, but I will do it here as a courtesy. Okay. How to annotate it? Yes. How to write over it? Yes, here it is. The 3 million, first of all, what is it? Where is the issue? Not properly explained. You see here, you see the consequences. The point I am explaining and the way you are writing, huge difference. Request from home management. Bank confirmation is not needed here. Because we need to check we need to check the risk we are discussing, classification, split. Response cannot be on any other thing. Remember that. So let us learn to draft it now. Let us learn to draft it now. So, company obtained 3 million of loan in June 20x5. The loan amount, yes, repayable in installments over 5-year duration. The loan should be splitted and recorded into current liability and non-current liability. The risk is that this classification may not have been done correctly by company, and liabilities may be misstated due to this misclassification. Now you can compare your answers with it. So auditor, with the risk is that classification may not be correct. So what auditor will do? Recalculate the split of loan into current and non-current liability. And verify it is correctly recorded in financial statement of company or not. That's it. That's it. Now, come back to the question again. Now, your answers, and this should be compared by you people. In preparation for expansion, the company is looking to streamline operation in warehouse, is planning to approximately 60 employees redundant. No decision was made as this will be announced in September. So what should be done? No decision was made. They are going to make 60 employees redundant. Right? So what happened? Announcement is not made. Now this is tricky. Student, if announced, now I'm explaining IAS 37 to you. Announcement is made before year end. A provision for the same should be recorded. If it is not made, okay, then it should not be recorded. So how to discuss this point? As risk, how to discuss it? It will be discussed like this. Peony company is going to make 60 employees redundant after year end, because it is after year end. If announcement has been made of the same before year end, as per IAS 37, a provision for redundancy payments needs to be recorded in financial statements. If they have not done, have not recorded, the provision at correct amount, expenses and liabilities may be understated. So if announcement has been made, now, because that is not clear even, discuss with management whether announcement was made of redundancy before year end. If yes, if it is so, verify, perform substantive procedures whether the redundancy has been provision has been recorded in financial statement at correct amount. Yes. Now, there was another point which I want to discuss with you people, which I actually deliberately skipped. When I was going through the scenario, I deliberately skipped that, because that was a bit different type of point. Yes, come here. This was the point. That is, the Peony company decided to outsource its payroll function. This one. To external service organization. They handle all the payroll cycle and send monthly reports. And it happened after the record was transferred. When the company, it is repeated tested point again. When a company has outsourced its department, so it means it may be have detection risk. Auditor may be unable to obtain evidence. It may not be able to perform audit work on the controls under which this record is being maintained, on the data of payroll. So detection risk is there. Now, how to then verify? So let us learn how to write about it, because it is a bit tricky point, but it is a repeated point as well. Next point. So Peony company outsourced its payroll function during the year to a service organization. So the risk is that Peony company may not have access necessary to verify completeness and accuracy of payroll record and controls over these processes may not be tested by auditor due to this detection risk. Hence, payroll and related liabilities may not be verified by audit work. Yes. This is a bit different point. Now, what is audit response? So with the permission of Peony company, auditor should contact the service organization providing payroll services to understand controls used by them for this service. Understand. Yes. This payroll service. Yes, understand the adequacy of. Now that's better. type 1 or type 2 reports should be requested. Now, what is it? Type 1 report and type 2 reports are reports on controls of the service provider. This is the response. I hope this is clear. Students, you have seen the whole picture in front of you. If you are not writing and getting it checked, it will be a problem for you. So I'm giving you 2-3 more days. Assignments given in the last week, send me in the next 2 days. Those who have not solved. If you are not doing that, you can see your answers, which I have checked. And you think you are writing correct, and you are not writing. And this is the only way to learn it. Solve, get that corrected. Solve, get that corrected. All right. Thank you for joining. See you. Take care. Goodbye.